Well, for more on the power transfer in the global economy, we can cross live to Martin Hedeke. He's Associate Director of financial advisory firm Tice Group Limited, joining us live there in Hong Kong. Now, what makes the IMF think that China could leapfrog the US 4 years ahead of the initial predictions?
I don't know which original predictions you are referring to now. You mean China overtaking the United States as the world's #1 economy? Well, actually, there are different projections. Let's just say the IMF is saying that China will overtake the US by 2016. You have the World Economic Forum, that's an independent think tank based in New York. They actually said that China might overtake the US next year. In many regards, China has already overtaken clearly the supposed #1 economy in the United States. And that's when you're looking at the physical economy, physical production, on a purchasing power adjusted basis, because the renminbi is undervalued, and you need to reflect that when looking at economic sizes.
It does seem a bit ironic, though, doesn't it, that China's the biggest foreign buyer of US treasuries. So you would wonder how a country with approximately 70% of reserves invested in dollar assets can really benefit from the US's current problems.
Well, I didn't say that. You said that, but basically, you have to put your money somewhere at the end of the day. And what you need to understand is, first of all, what's the nature of the Western debt crisis? We have had a projection by Standard & Poor's made in the year 2005. There was 6 years before now, where they actually projected that all the major Western governments were heading for junk status, including France, the US, Germany, and the UK. And they're saying that the US would lose the AAA rating status in 2016. So now we are actually 5 years ahead of that original projection, and there was a major rating agency saying these things might happen even well before the financial crisis hit. And now the balance sheets of these countries, if anything, would have only gotten worse, which is why the US has lost the AAA rating. They needed to fund the bank bailouts, now also in the Eurozone funding all these PIGS countries bailouts. And soon after the triple rating was to be lost, you could see the downgrades projections that were made back then, leading quite soon to junk status. And what that means is, when you have economies, major economies, where the deficits and debt are out of control, and you have this kind of projections on the line, that means that these countries are usually going to print their way out of the problem. So the main risk and the new form of this financial crisis will probably be very high to hyperinflation in the Western currencies. And that means, investment-wise, you need to look at other areas, particularly gold, precious metals is something we have been advising for the past 10 years. We still are optimistic on that. And then Asian emerging market economies look a lot better than the Western countries. And even equities generally in those emerging market economies, such as China, they represent some form of assets that are more inflation-proof than cash and bonds. So unlike in 2008, where commodities and equities were the worst thing to be in, ultimately, as an end result of the crisis, this time around, commodities may be the real safe haven to be in, and equities may actually outperform bonds, because equities are more inflation-proof than bonds.
You talk about the end result of the crisis. What are we looking at here? Are we looking at another global recession?
Well, we are looking at potential national bankruptcies of the Western countries, as projected by Standard & Poor's quite a while ago. So that's what we are looking at. We are looking at a government bond crisis. The 2008 crisis was a banking crisis, a stock market crash. Now we are looking at the heart of the financial system, which is the government bonds. And then when people lose trust in those government bonds, then they will also lose trust in the currencies and sell off the currencies.
And of course, just to ask you, those credit rating agencies, they cause people to lose trust as well, don't they? Just how credible are these ratings agencies, and how responsible are they for this panic now?
Yeah, well, some people say it's only because of the credit rating agencies. Well, first of all, I don't like them at all. They are not reliable. Remember the subprime papers in 2008 they were rated AAA, and then the next thing you know they were basically frozen, and there appears to have been quite a bit of conflict of interest. So I think actually the Chinese rating agency Dagong is a lot more reliable than the Western ones, but they have already downgraded the US to single A now with negative outlook, and there are a few others more reliable ones. But certainly I don't think that it's only the rating agencies that are causing this mess in Europe and the United States. Now, in fact, these ratings are well overdue. Probably more realistically, when you're looking at the total fiscal gap, the whole shortfall of the United States finances, that number is 211 trillion US dollars. You Google Lawrence Kotlikoff, professor of economics at Boston University in the United States. He's writing for the Federal Reserve Bank, for the IMF, and so on. Look it up, fiscal gap, 211 trillion US dollars. That's not too far from Greece. And therefore, I mean, the US, even AA rating, that's ridiculous. They should be far lower. So the rating agencies aren't exaggerating here. Even in Europe, they should all be rated far lower than they are. And they have their own problems, not just because of the rating agencies.
Okay, Martin, thanks so much for sharing us your thoughts. Martin Hennecke, that's all we've got time for. Associate Director of Tice Group Limited, talking to us live from Hong Kong. Thanks very much indeed.